Ladies and gentlemen, a very warm welcome to our latest and exclusive show, Macronomics. I am Devang Mehta, the head of marketing at Anand Rathi Group, and I will be your host for the webinar. Tonight, I have been assigned the privilege to host a very dynamic personality who is bubbling with knowledge. He is a rated market economist, macro strategist, and has been head of research at Anand Rathi Institutional Equities. Previously, he was a director in the economic research team of RBI. He has represented India at forums including G20, IMF, UNCTAD, and WTO. He has not only authored 20 research articles, but also a book. He is an all India topper in UPSC and RBI economist recruitment test. Ladies and gentlemen, he's also a topper in MPhil and was amongst the top 5% during his MA. Currently, he is the chief economist and executive director at Anand Rathi. This personality is none other than Mr. Sujan Hajra. Before I call Mr. Sujan Hajra to the dais, I would like to inform you that this show is not going to be an ordinary one-way presentation. You all have to take part in it. The Q&A section at the bottom of your screen on the Zoom screen is active now, and you can ask all your relevant questions to Mr. Sujan. Once he finishes his presentation, we will have a small round of Q&A, and I will handpick a few questions, and Mr. Sujan will try and address those questions. So, ladies and gentlemen, without spending any more time on my talks, let me welcome Mr. Sujan Hajra. Mr. Sujan, welcome to your own show, Macronomics with Sujan Hajra. The dais is all yours, sir.
Thank you, Devang. And as you said, this is our journey is just starting. This is the first of the events which we are going to do, and this is going to happen every month. This month, what we have done, Devang, is that we have chosen more towards the equity market because there is a lot of concern that we have seen that the equity market has done extremely well since April 2020. But if you look at in the last 1 month, the market has corrected almost 3%. Now, there is a lot of apprehension whether this is just a bull market correction or this is the start of a bear market. So keeping that in perspective and what I'll do today is I'll try to give a holistic view on where do we see this equity market going, what are the factors which can influence the equity market. So without further ado, what I'll do is that I'll share a presentation, and we'll take it from there. So and I welcome everybody. I understand on a Friday, all of you have joined, and we are really very pleased that you could join today. So hope this is going to be worth your time. So as the title suggests, that is the festivities over, the kind of, for almost 18 months, the kind of equity market bull run which you had seen, is it coming to an end? Are we in for a big market correction? That's something which we are going to discuss, and we are going to discuss it from all possible perspectives. First, we'll try to look it in terms of numbers. So more of a technical kind of a view, though not in terms of charts, but more of a technical kind of a view where the market is going. Then we'll see whether the economic factors and the equity market, there is a feeling that while the equity market has gone up so much, the economy is not doing so well. So is that view right? Is the equity market going in one direction, the economy is going another direction? That's another thing which we'll discuss. Third, we will see whether the equity market is in sync with the corporate performance. We will also look into the valuation aspects of the equity. And after covering these four segments, these four areas to look at the equity market, what we will do is that we will try to give a perspective of what is likely to happen going forward. So let me start by telling that yes, this is true that the equity market has gone up a lot. If you look at in the last 12 months, large cap, that is Nifty, has gone up almost 40%. Mid caps have gone up in excess of 60% and small caps have gone up in excess of 80%. So clearly there has been a very, very significant run up. And if you look at from April 2020, as we know that the market made a bottom in March 2020. So from that bottom, the large cap has gone up 135%, mid cap 170%, and small cap 230%. So by any stretch of imagination, since April last year, we have seen a very strong market rally. And as a consequence of this rally, if you look at right now, the 1-year return stands at 39%. 3-year return annualized stands at about 19%, 5-year about 17%, and 10-year about 14%. But if you compare these returns with the kind of return the market generally produces, say ET1, yearly return of about 11.6%, 3-year return of about 9%, 5-year return of about 10%, and 10-year return of about 12%. So clearly you see it's not just that the 1-year return has been very high. If you look at 3, 5, or 10-year horizon also, the current returns are significantly higher than the average return which we have seen since 1991. Now we know in the equity market, generally, if the market goes up too fast or market goes up too much, then subsequently the market corrects. Similarly, if the market goes down too much, subsequently the market goes up. Clearly now we are in a situation where the market has gone up a lot. So is it a time, is it likely that this market is likely to go down? Is the kind of return which you are seeing right now, are these abnormal kind of return? Surprisingly enough, these are not abnormal returns. If you go back in the 1990s, 23% of the time, Nifty has given more than 50% return. If you go back to the first decade of the millennium, that is in the 2000s, you see 16.5% of the time, the market has given more than 50% return. But if you look at the last decade, only 3% of the time market has given more than market has given more than 50% return. So 50% plus return, which prevailed until recently, that was very rare since in the last decade. And since it was very rare in the last decade, investors generally look at the immediate past to draw clues about the future. Since during the last decade, we have seen very few periods of high return. Now this kind of return is looking very abnormal. But as I said, if you take a more broader view, if you take a longer term view, the current returns are pretty common in the 90s and in the first decade of the millennium. So by any stretch of imagination, these returns are not excessive return. These are pretty much in line with what has happened in the past. But having said that, market has gone up almost 40% in the last 12 months. That is history. What is going to happen now? Is it that since the market has gone up so much, there is a huge probability, there is a huge chance that in the next 12 months, market will generate negative return or at best a very low return? Actually, that is not true. If you go back again since 2000, whenever market has given you more than 50% return, after 50% return in the last 12 months, in the next 12 months, almost in 88% of the cases, that is almost 90% of the cases, market has given you positive return for the next 12 months also. So after achieving a 50% return in the previous 12 months, the market in almost 90% cases given you positive return. And on an average, if you take just the mean, market has given you 11% kind of return. If you take the return median, market has given you 14% kind of a return. So the past data tells us that it's not that whenever market goes up the way it has gone up in the past, recent past, it's not that the market corrects after that. In fact, the market continues to remain in the positive territory. And in the next 12 months, market gives you anything between 11 to 14% return. But so if you look at the market numbers purely in technical terms, there are not much reason to be worried. There it is like the data is suggesting high level of probability that in the next 12 months you will continue to get positive return, anything between 11 to 14% return. The kind of return you won't get perhaps in any other asset class, whether it's fixed deposit, whether it's the bond market, whether it's gold, whether it's real estate. Most of these asset classes won't give you 11 to 14% return in the next 12 months. But going by the past history, this is the kind of return which you can expect from the equity market. But having said that, isn't it that the Indian economy is not doing very well? Yes, we understand we are doing better than what we were doing before the pandemic. But isn't that there are lots of areas in the economy where we are doing pretty badly? In fact, no. In the next 3 slides, I'm going to show you 22 different economic indicators. And you will see vast majority of these indicators are suggesting not only we have recovered very smartly from the pandemic lows. In fact, currently we are doing significantly better than what we were doing before the pandemic. For example, if you look at exports, these are all numbers in absolute terms. Before the pandemic, our monthly exports were on an to $27 billion. Right now, our monthly exports are between $32 to $34 billion. So they are doing better than we are before the pandemic. The same is true for imports. Imports are much higher. So the domestic demand is much higher. And these are goods exports and goods imports. Even if you look at the services exports are also doing better, mainly software. They are also doing better, monthly export of about 20 billion as compared to 17, 18 before the pandemic. If you look at foreign direct investment, that's also doing much better now than before the pandemic. If you look at electricity consumption and generation, which basically gives you a broad-based view of how the economy is doing, that's doing much better. Industrial production, infrastructure index, collection under goods and services tax, all these are suggesting that the economy currently is doing significantly better than what it was doing before the pandemic. The list doesn't end here. If you look at the EUA bills, as you know, under GST, if you have to transport anything for commercial purpose, you have to raise a EUA bill. And so the number of EUA bills basically tells that how much of cargo is in movement. And if you look at those numbers, these are significantly better than what was happening before the pandemic. If you look at railway freight, if you look, it's doing much better than what it was doing before the pandemic. Similarly, look at the bank deposits, the bank credits, everything is doing significantly better than what was happening before the pandemic. There is a forward-looking indicator. This is called Purchasing Manager Index for manufacturing production. This is a survey-based estimate. Purchasing managers are interviewed and they give the outlook for the near future. And here also we see that the business sentiments are pretty strong. Now, one area on which there is a lot of debate, people think that because of the pandemic, there has been a lot of job losses. And still the employment situation in the country is pretty bad. But if this is an index, this is called the JobSpeak Index. This is actually published by Naukri website, Naukri. So they have an index which tracks how much employment is getting generated. And if you look at currently, this index is at all-time high. So the job market, according to this Naukri Speak Index, is the best ever right now. Now, we are looking at another job market data. In this case, we are looking at Employees Provident Fund data. Now, Employees Provident Fund data, basically, if you are in the organized sector, if you are working with a company, so what has to happen that the employees to Provident Fund, they have to contribute there. So there is every month there is a number of people, new people who are registering with the Employees Provident Fund. Some people who are either retiring or losing job, they drop out of that list. Now, Employees Provident Fund organization every month gives us a net number. How many new addition minus whoever has dropped out. Now, this number stands at 40 lakh per month in the recent months, which is all. So this basically means 14 lakh new job in the organized sector is getting created every month. So you might have heard that the job market situation in India is pretty bad, but we are showing you two very different indicators, and both are suggesting that the job market situation in India is actually the best ever. But while I showed you 15 different indicators which are suggesting we are doing pretty well, there are also some indicators which are suggesting that some areas of the economy is not doing so well. For example, if you look at number of air passenger traffic per month, this number is less than half of what was happening before the pandemic. The same is true for railway passengers. If you look at car sales, the automobile sales, just after the lockdown started getting withdrawn, these numbers jumped. But in the recent past, these numbers are not particularly good. Same is true for two-wheelers. So clearly, there are some enclaves of weakness. Similarly, if you look at as compared to the manufacturing sector, the services sector is not doing so well. And car registration also depicts what you see in terms of car sales and two-wheeler sales. And because because the services sector being larger than manufacturing, at the overall economy level, though we are doing significantly better than before the pandemic, but the extent is not so high. So net on the economy front, what you will see, there are more positive indicators than negative indicators, and almost in all segments, barring some segments like transportation, out of home entertainment like movie theaters, some parts of retail trade like malls. Leaving apart those segments, the economy is doing very well. Now, if you look at Nifty was close to 12,500 before the pandemic. Nifty today is close to 17,500, 18,000. So the economy is also moved up. The equity market has also moved up. So the perception that the equity market is going in one direction and the economy is going in another direction, clearly, if you look at in terms of data, that understanding is not right. But what about the corporate sector? Is the corporate sector doing as well as the economy? Is it doing better than the economy? In fact, it's doing much better than the economy. These are the number of corporate sales. This is the data which is published by the Reserve Bank of India every quarter. We have data till quarter ending June 2021. This is the aggregate sales number of about 2,500 companies, both listed and unlisted. If you look at in March 2021, the amount of sales was more than 1 lakh crore, the quarterly sales, which was a record high. Though there has been a slight dip in June, this is likely because March being the year end, next quarter the number dips a bit. What is interesting is that the sales numbers are impressive not only for the overall corporate sector. Even if you look at segment wise, cement, chemical, IT, construction, electricals, iron, steel, almost everybody is at their peak sales level during either quarter ending March 2021 or quarter ending June 2021. So clearly the sales number for the Indian corporate sector is very strong. And the situation is even better if you compare the profit number for the same companies. If you look at during the quarters after the pandemic, the profit numbers for the companies are significantly better than what was happening before the pandemic. And unlike sales, what you can see in terms of the profitability number, only cement and iron and steel, they are at their all-time peak. There are lots of sectors where the profitability number is significantly lower than their best. So which gives us further hope that as situation normalizes further, the corporate profitability, which in equity market terms we talk about earnings growth. The earnings growth momentum will continue. Currently, the earnings growth for the 50 companies which are part of Nifty 50 is growing by 80 to 90% over the last year. But obviously, this kind of growth number is not sustainable. But 18 to 22% growth in corporate earnings is something which is pretty much likely. So far we have covered that from the technical perspective, from macro perspective, from corporate perspective, all the things are in place, and there is no reason to expect that that the equity market is going up, whereas the corporates are not doing well, or the economy is not doing well, or we are in an uncharted territory which you have never seen before. These are a lot of people are talking about, but this is not true. This is not corroborated by data. But having said that, what about the valuation? Are the Indian equities extremely expensive? Once again, no, it's not extremely expensive. So generally, we talk about equity market valuation in terms of price to earnings ratio. Price to earnings, as you know, price to earnings ratio basically looks at what the level of the market today. Say, for example, if Nifty is at 18,000, that is taken as the price. For example, if the profit for the Nifty companies for the past 12 months was 900, so then 900 is the earnings. So you divide 18,000 by 900, you get 20. That becomes the price to earnings ratio. So if you look at the average price to earnings ratio between 2015 to 19, for Nifty 50 was about 24.6. Currently, it is 25.6. So slightly higher, not significantly higher. But what you have to understand, the stock market is not so much. This is the earnings for the last 12 months. But if you look at stock market is not so much bothered about what has happened in the last 12, 24, or 36 months. Stock market is bothered about what is likely to happen in the next 12, 24, or 36 months. So if we take 1 year forward P, assuming just 16% growth in Nifty earnings, as I said, currently the earnings is between 80 to 90%. But if we just assume that the next 12 months it will grow only by 16%, the 1 year forward price to earnings ratio, the average between 15 to 19 has been 24.4. Whereas right now, the earnings ratio, the 1 year forward earnings is about 21.8. So clearly, while the valuation of the Indian equities is not cheap, it's not extremely expensive either. It's pretty much close to the average, slightly above the average if you take the earnings for the previous 12 months, and slightly lower than the average if you take the earnings for the next 12 months. And there are reasons to expect actually the price to earnings ratio under the current situation can actually go up. Why? Because ultimately, when you value a company, when you derive the valuation of a company, how do you derive that valuation? You derive the valuation by first estimating what is going to be the sales and revenue, the profitability of the company for the next 2, 5, 10, 20 years. Now, once you estimate the profits of the next 2, 5, 10, 20 years, now obviously 100 rupees today, 100 rupees 5 years from now, 100 rupees 20 years from now is not the same thing. So you have to basically discount the future earnings and arrive at the current value of the future earnings. Now, when you are discounting the future earnings and deriving the present value, what is the discount factor you use? Generally, you use the discount factor, what we call the risk-free rate. What is the risk-free rate? The risk-free rate is the interest rate on 10-year government bond. Now, the lower the discount rate, the higher is the valuation, because you are discounting the future income by a lower discount rate. Higher the discount rate, the lower is the valuation of the company. Now, right now, the 10-year government securities yield is 6.34. The average between 15 to 19 was 7.29. So earlier we are discounting the future value by a higher discount factor. Right now we are using a lower discount factor. So in fact, even if we look at that 21.8 PE, there are chances because of the lower discounting factor, this PE can go up significantly. Now, having said that, people often say that, okay, Indian equities are doing well. I understand the valuation is reasonable, but isn't it that there are a lot more opportunities in other markets and things like that? Actually, that is not true. If you look at the major countries of the world, you look at developing countries, emerging market countries like Russia, Mexico, Indonesia, Brazil, China, or you look at industrialized countries like France, Germany, US, Japan, UK, whichever way you look at, India is the best performing equity market from a 1-year return perspective, 2-year return perspective, 5-year return perspective, and 10-year return perspective. So clearly the Indian equity market has been the best performing equity market from whichever time horizon you look at, 1, 2, 5, 10-year horizon. So even from an international comparison, Indian equity market is looking extremely attractive. Now, they rule out a market correction. Can I rule out that market won't go down from here? Absolutely not. In fact, here I want to show you a very interesting chart. There are actually two parts to this chart. The upper part of the chart basically tells you how much yearly return Nifty has generated. So basically, if you invest on the 1st of January Nifty and remain invested till the 31st December, this is the return you generated. So if you invested in the 1st of January 1991 and remain invested till 31st December 1991, you made a 75% return. So and so forth for other years. Now this light blue or this sky blue lines are the how much the market has run up during a particular year from the bottom of the previous year. So 105 means 105 for 1991 means that in 1991, at the highest point of the 1991, Nifty had run up 105% from the lowest point of 1990. So say, for example, for the current year, from the bottom of 2020, the market has run up 141%. What is this number, minus 36? This is from the peak of the previous year. So whatever was the highest point of 1990 and whatever has been the lowest point of 1991, this is how much the market has corrected. Now, clearly, if you look at these numbers, what you will realize, is kind of a market correction from the peak of the previous year. This is more of a rule rather than exception. So can the market, this year, the highest correction we have seen from the peak of 2020 is just 2%. This is very low. So it's quite possible. It's quite possible that market can correct from here by 5%. Market can correct from here by 10%. As we know, since October 2021, the market has already corrected almost 3%. So this correction can continue. But what is more important to look at, if you look at from 2002 onwards, out of 20 years, only in 3 years, in 2008, 2011, and 2015, Nifty had given you negative return. So but out of these 20 years, in 17 years, you got positive return. So there is an 85% chance that in a given year, equity will give you positive return. And on an average, as I said, it gives you about 12-13% return. So the point which I'm trying to tell you is that equity market by nature is volatile. A 5-10% market correction cannot be ruled out. But if you remain invested in the market, you are likely to generate significant return. But unfortunately, many of us, many a time, try to invest for the short term. And the last slide I'm going to show you, many a times we just look at the return, but we don't look at the risk. But if you are a short-term investor, there is a huge risk which you are taking to generate a return. Now, let me explain this chart. Here, if you have invested in the Indian equity market anytime from 2010 to 2021, and if your investment horizon is 1 year, on an average, you have made a return of 18%. But what is the risk you have taken? On 46% of this occasion, you could have lost your money. So what you would have got a money back, which is lower than what you are invested. How do you measure this 46%? This is the number of days. Say if you basically this tells you that since 2010 till date, on 46% of the days, the market has closed in the negative. On 54% of the days, the market has closed in the positive. So this is measured as the risk of your capital loss. Similarly, if you invested for 7 days, the return could be about 19%, but the risk is about 44%. So there is a 44% chance that you will lose your capital. But interestingly, if you go into 3-year kind of a scenario, now the return is 9%, obviously lower than 18% return for 1 year. But what is the risk? The risk is just 3.5%. So basically, you have a probability of 96.5% that you won't lose any money. While the probability is almost 50% that you will lose some money if you are investing for 1 day. If you are investing for 7 days, the chance of losing money is 44%. If you look at if you are investing from a 5-year horizon, there is a 98.4% chance that you won't lose any money. And at least going by the past data, there is a 100% probability that you won't lose any money if you are investing for a 10-year horizon. So this is the basic reason why we tell in Anand Rathi that if you are an equity investor, generally your investment horizon should not be less than 3 years, because in that case, you are going to get a steady positive return with very little risk. So just to conclude, we remain positive about the outlook for the Indian equity market. We are not telling that there cannot be any market correction. Rather, we are telling a 5-10% kind of a market correction is rule rather than exception. But having said that, if you are a long-term investor, the macro factors, the corporate health, the valuation, the technical factors, all are suggesting that the prospect for the Indian equity market is pretty bright. Annual return of anything between 11 to 14% is something what we expect this market will yield. So I'll stop, and Devang, I'll give the forum back to you.
Sure.
For your.
Sure. Thank you so much for this.
Thank
you so much for this insightful presentation, Sujan. A lot of interesting numbers, a lot of myth breakers when it comes to numbers, particularly the economic indicators. So we have a few interesting questions from our viewers who are connected to us on the Zoom right now. So let us take a few questions from them, and then I'll have a few questions of my own. So let's see. First, the first up is Mr. Sanjay Kikeri. He is asking you that everyone is talking about China plus one strategy, and India will be a big beneficiary post-pandemic. That is his view. Is there any visibility, or is there any truth to this particular statement when it comes to on ground or when it comes to the real market?
So while I was showing you the economic indicators, 2 things I showed you. One is that India's monthly export before the pandemic and after the pandemic, the monthly exports have gone up almost by $7 billion a month. So, say from about $25-26 billion, we have come to $32-34 billion a month kind of export number. Now, if you look at 7 billion over a 12-month period, you are going to get a number of almost 100 billion. So clearly, we are seeing that India's export numbers have gone up significantly. post the pandemic. So that can be partly because that cannot be exclusively because of China plus one, but China plus one might have helped that. The second indicator which I showed you is the India's foreign direct investment has gone up very substantially. On a last 12-month basis, say what we call trailing 12 month, India is receiving anything between 80 to 100 billion dollar as gross foreign direct investment. Again, we are seeing there has been a huge pickup. This number used to be 50-60 billion dollar earlier, but now this number is between 90 to 100 billion dollar. So clearly this number is looking good. In terms of sectors, where we are seeing India is doing very well in China plus one strategy. One is chemicals, particularly specialty chemicals. We are seeing a lot of traction. Pharmaceuticals, we are seeing a lot of traction. What do we expect going forward in the automobile space? Also, we expect a lot of traction. Consumer electronics, including mobile phone, AC, these are the areas where we are likely to see. So you are right, the China plus one is not just a talking point. We have live data which are suggesting this position. Back to you, Devan.
Sure. So there is one question which is connected to this same question, that the corporate sales numbers that you showed, these are really strong corporate sales number. So what are the major contributors to this particular sales numbers? Obviously, like you said, China could be a part of it, but are there other major contributors contributing to this fantastic sales numbers for Indian corporates?
Sure. There are lots of factors, and obviously China plus one I'm not talking about. I'll talk about just two major factors which are helping it. One, and this is intuitively all of us know, what has happened is that, and this has happened not only in India but globally. After the pandemic, the market share of larger companies have gone up. Now, why the market share of the larger companies have gone up? First of all, the larger companies have better financial power. Second, they have better supply chain arrangement, and third, they have better distribution network. So they have taken the market share away from the unorganized sector. In fact, in India, this process started much earlier, particularly demonetization and GST. We saw the share of the organized sector going up. So part of the reason why the corporate sales numbers, and obviously these are for larger companies, corporate sales number is good because they are taking market share away from unorganized sector. This is one factor which is happening. Second, and this is very India specific. If you look at the Indian economy since 2008, between 2008 to 2020, all our economic strategies were to boost growth through consumption. Say, for example, loan waiver, for example, subsidies, for example, more social spending, basically either cutting tax or putting money in the hands of people. So through consumption, we are trying to boost growth. But the problem with the consumption-driven growth is that it's very inflationary, because it creates demand, but it doesn't create supply. But first time after 12 years, India is trying to boost growth through investment. For example, if you look at the Make in India scheme, or you look at more recently the Atmanirbhar Bharat, if you look at production-linked incentive scheme, all these things are trying to boost investment. The positive thing about investment, one is this creates both demand and supply. So this is less inflationary. The second thing is that there is always a multiplier effect of investment. For example, if you are building a bridge, not only you are creating demand for cement, steel, iron and steel, for labor force. Once the bridge is completed, your transportation time goes down. So there is a productivity improvement happens. So so both the factors, that the organized sector is getting market share, and second, India's development strategy has changed from a consumption-based to an investment-based theme, which has a multiplier effect, has a lot to do the corporate sector is doing well. So back to you.
Sure. So, Sujan, we have we have Kanchok Sandhu with us, who's asking which sector is performing best or will perform higher in the next quarter. Though you answered this while answering the question number one, but if you can just reiterate it once for Mr. Kanchok's satisfaction.
So what we are clearly seeing that the investment theme is doing much better than the consumption theme. By investment theme, I mean infrastructure, I mean capital goods, I mean metals. So these are the kind of sectors which are doing well. The segments which are not doing so well is, say, so-called FMCG or durables, including auto. That's the space which is not doing well. Second, what we see is that cyclical sectors are doing well. Say metal again is an example of cyclical. Metal, power. These are the sectors which are doing well. Whereas the defensive sectors, for example, staples, for example, pharma, these are the sectors which are not doing so well. So going forward, we'll expect particularly the investment in segments will do very well. So that's the kind of perception which we have.
Sure.
Back to you, Devan.
Sure. So Mr. Yash Shah has asked you a question saying that as inflation rises in India, are value stocks, the valuations of what we call value stocks, is that sustainable?
That's a very valid point. And if you recall in the whole valuation part, I was talking about the discount rate. So if the interest rates go up, the discount rate goes up. And as I suggested, if the discount rate goes up, that means value of the company goes down. So the valuation becomes more expensive. So that is absolutely true. But having said that, here are two things which you have to understand. The first thing is that what we are discounting expected future income. Now, if the economy is going through a high phase, that is, if there is an acceleration happening, that's what I'm trying to argue, that's what is happening, then the value of your future income also goes up. Yes, your discount rate is going up. So your denominator is going up because the discount rate is going up. But the value of the cash flows also are going up. So what becomes the overall valuation will depend how much the future expected incomes. If the future expected income are growing faster than the discount rate, then overall valuation will go up. And if it's the other way around, then it will go down. So there is no clear answer there. Second thing is that now clearly Reserve Bank of India is going to raise the policy rate, the repo rate or reverse repo rate. But will it really result in the interest rates going up? We are not very sure about that. Why? Because right now there is excess liquidity in the system. And interest rate ultimately is the cost of liquidity. So if the liquidity remains high, even if Reserve Bank of India raises interest rate, banks are not going to increase either the lending rate or the deposit rate. So we are not very sure that even if in responding to inflation, Reserve Bank increases the policy rate, that will actually result in interest rates going up. Devan?
Yeah, sure. So we have two questions from Vidya Vishwanatha. I'll read them in a combined manner. So first question is, many companies in chemical and pharma, she has given examples of Balaji Amines and Deepak Nitrite, have gone up. Is this due to a pent-up demand, or is this a sustainable demand which will go on for the future also? As per her, there is a confusion in this particular area when it comes to the investor's mind. Do you hold stocks in this sector or you let go?
Now, whether you hold or let go, that depends stock specific, but I'll talk about more about the dynamics, what's happening here. So here, this is one area where China plus one is playing a big role, particularly in the specialty chemical. Now China, because China is for environmental reasons, they are closing a lot of chemical shops and chemical factories, I mean. And India, outside China, India has one of the biggest base for chemicals. India always had. And while China is better in terms of producing large scale chemicals, India is more into chemistry skills and in terms of specialty chemicals. So there, India is making a very big progress, and China plus one is playing a big role. Also, there is a lot of import substitution happening. Earlier, we are getting from China, and that is also true for parts of the pharma. For example, there is something called API, active pharmaceutical ingredient. So that is basically the bulk drug, and then you produce in doses from that bulk drug. Now, earlier India was importing a large part of the API, a significant part of that from China. But under the Atmanirbhar Bharat, under this Make in India, we are trying to produce a lot of it. And because of the supply disruption which happened during the pandemic, a lot of domestically produced API. So API has become one of the largest segment. So in that sense, China plus one is playing a big role here. Now, so far as now, the problem is that while we can have some common view about engineering sector among about banks, about FMCG companies, it's very difficult to take a common view on chemicals or pharma, because they have very specialized segments within that. Banks are ultimately in the business of taking deposits and lending money, but a benzene-based chemical company is very different from oleochemical company. Excuse me. Sorry. So in that sense, it's very difficult to take a view on chemical sector or pharma sector as such.
Right.
But having said that, the long-term prospect for both the segments are. Back to you, Devan.
Yeah. So Vidya, again, I mean, the second part of the question was, is it a good move to invest in sectors which have been positively impacted by the economic recovery, or should an investor ideally be investing in stocks that have corrected by 30-40%?
First of all, in Anand Rathi, we think we always tell that for individual investors, a significant part of our investment should be through mutual funds. Why we tell that? It's not that mutual funds do any rocket science, but in the mutual fund, the analysts and the fund managers, for them, it's a 24/7 job to manage fund. Whereas you as an individual investor, you have only limited bandwidth with which you can monitor the market, with which you can take the investment decision. So the best way, a significant part, the best way to put a significant part of your investment should be through diversified equity mutual fund schemes. Now, if you want to invest directly, into equity, what I would say that you should not have too much of sector bias, because what happens is that typically the cycle for a particular sector, say for example, if you look at realty is a sector which was underperforming for 12-13 years. Suddenly it's the best performing sector. Same is true for power. Whereas say if you go back last year, pharma was a blockbuster sector. Pharma is doing pretty badly this year. So don't try to have, as an individual investor, if you have to invest directly into equity, invest in a diversified manner, because none of us know for sure. There is always a probability. You can say a 70%, 80%, never 100% probability. So you should not look at only return. You should look at risk also. The way in the last slide I was talking about risk and return. Just don't look at return. Look at risk. So now coming back to your point, basically what you are asking, whether you should invest in growth stocks or value stocks. Growth stocks means the companies where the earnings are going to go up, are expected to go up significantly, and value stocks which have corrected. So today you have hardly any stock which has corrected 30-40% in the recent past. Today picking up value stocks becomes extremely difficult. But having said that, what we think the best part about the two biggest thing about investing successfully, one is have a discipline. You decide you decide your risk appetite, decide your return expectation, and try to fit in stocks which fits into your type of investment expectation. And second, have patience. Don't get
Right.
unnerved if the market goes down 5-10%.
Right.
Back to you,
Sure.
Devang.
Sure. So, in the interest of time, we'll be taking another one or two questions, though the questions are flowing in, but we'll take another one or two questions. There is one interesting question from Chunnilal Thakkar. It's a critic question. You need to tell us whether it's right, wrong, and if it's right, then why. So, if our earnings is the highest right now, why are FIIs pulling money? Why are FIIs pulling out money? So, is this statement correct? First of all, if yes, then why?
So, if you ask me for the calendar year 2021, FIs are net investors. They have put in more money than they have taken out. If you are talking about the financial year, they have marginally taken out money from India, a very small amount in terms of. Now, the point is that if you look at globally during the current year, uh, the investors are last year, that is 2020, was one year when global investors shifted from developed country to emerging market countries. This year, the theme is just the opposite. They are moving out of the emerging markets and they are going into developed countries. And in fact, if you look at in terms of performance, the developed countries are in the equity market, whether you look at France, whether you look at Germany, whether you look at US, they are doing much better than the emerging market countries like China, Brazil. They are giving you negative return. India is the only exception. Even year till date, India is the best performing market globally. I have shown you in the slide. So now you have to understand, in the stock market, whenever somebody has to sell if somebody else has to buy, because you can't have all buyers or all sellers, then the market won't function. In the recent past, mutual funds are buying, and it always happens that every time either the mutual funds have to be on the selling end, because if you look at today, the FIs hold 21% of the market cap of the Indian equities, and if you look at in terms of free float, they hold about 43%. So they have faith on India. That's why they hold 43% of the free float of the Indian market. So if that is not a seal of confidence, I don't know what else is. So back to you, Devang.
Sure. So there is a question from Mr. Sunil Madan. He's asking any possibility of stagflation in India. So this terminology is fairly new for me. So I would like to hear your answer on this. So is there any possibility of stagflation in India?
So stagflation is the combination of stagnation and high inflation. So that's what it's called. But now stagflation is a very fashionable name. If you go into the economic history, not only for India, for any country in the world, stagflation is almost non-existent. Because there are lots of talks about stagflation, but the real life example of stagflation, that inflation is going up whereas the growth is going down, that's extremely rare and happens for very short periods of time. According to IMF estimate, India during the current year will grow by 9.5% in real terms. India will be the fastest growing country of the world this year. Next year, IMF estimates India to grow by 8.5%. Once again, India will be the fastest growing country of the world. Our inflation has come down from 8% last year to about 4.5% currently. So this is just the antithesis of stagflation. Our growth is going up, our inflation is coming down, and our inflation is coming down in a period when the global inflation is going up at 6% plus. US is sitting at the 30-year high inflation. For us, we are sitting at an inflation which is significantly lower than last year. So first of all, stagflation in itself is like an unicorn, which does not exist in real life. It's a tooth fairy kind of a concept. It doesn't exist in real life. Second, India is going in the the diagonally opposite direction of stagflation.
Right.
So Devang, should we stop? Should we stop now, or maybe the last question?
Yeah. This is the last question. I was going to say that this is the last question. There are two people who have asked similar question, so I'll club it into one. Mr. Talukdar and Mr. Hari K have asked a similar question. That what is your view on the credit growth in India, and do you think the excess liquidity in the banking system will contribute to inflation? So, in a way, Mr. Talukdar has also asked a similar question. The answer to this will answer both of them.
Sure. So if you look at right now, India's credit growth is about 6%. India's deposit growth is about 8%. Now, in fact, if you look at the deposit growth has actually decelerated slightly. A couple of months back, the deposit growth used to be more than 10%. And credit growth, in fact, has accelerated a bit. It was around 5% a couple of months back. But having said that, the point which you have raised is valid, that because the credit growth is lower than the deposit growth, there is excess liquidity in the banking system. Until recently, the excess liquidity in the banking system was to the tune of 8 lakh crore, 8 trillion rupees. Right now, it has come down a bit because of RBI's various intervention. This is a very valid point that that if there is so much of overhang of liquidity, and liquidity is chasing return, then there can be inflation. But having said that, if you look at, in fact, directionally, the liquidity is coming down. Directionally, the deposit growth is coming down. Credit growth is accelerating. So what I think is that, if anything, and RBI has clearly given indications that RBI will continue to suck up liquidity through various measures. I don't want to go to that technical discussion, but RBI is telling that it will continue to withdraw liquidity, though the overall liquidity will remain accommodative. So there is some bit of risk that this liquidity overhang spilling, getting into making the inflation higher. But having said that, I think that directionally the liquidity is going down, which should actually tame inflation. So so the risk is there, but I don't think with a very high probability.
Sure. So thank you, Sujan. This was the last question that we will take for the day. I'm really sorry to everyone who marked their questions and we were not able to answer those today. We'll definitely come up with more sessions where we'll be able to answer more. Thank you, Sujan. I must say this was a very, very interesting session. I'm sure all our investors who joined us today on Zoom, as well as the viewers who are viewing us live right now on YouTube, only stand to gain from this particular session. And ladies and gentlemen, thank you so much for joining us today and spending your precious time with us. Wishing you all a very happy weekend. With this note, let's call it a day, and thank you so much for joining.